The Buffett principles discuss the investment strategies of the legendary Oracle of Omaha, Warren Buffett. He's widely regarded as the greatest investor in history. He transformed a $100,000 stock investment into more than $20 billion, wealth that would take 100 average families 10 generations to spend. In 2008, Forbes ranked Buffett's net worth higher than Bill Gates, making him the world's wealthiest person. Every year, Buffett's letter to shareholders is studied like a biblical text in investment circles. On February 25th, Berkshire Hathaway, Buffett's company, released his annual letter to shareholders, offering valuable insights to investors. Buffett maintains an air of mystery because he requires all relatives and friends to maintain absolute secrecy about his investments. He primarily works from home, where his family witnesses his investment practices daily. Each family member is remarkably skilled, but they follow the patriarch's rules, quietly accumulating wealth. How does Buffett pass on his investment wisdom to his children? Every Christmas, he gives each of his children, sons-in-law, and daughters-in-law an envelope containing $10,000, instructing them to invest in stocks that he has recently purchased. Undoubtedly, these second-generation heirs benefit from insider knowledge, as these stocks typically soar in value. The book's author, Mary Buffett, was a successful entrepreneur running 2 companies in the 1970s before marrying Buffett's son, becoming the daughter-in-law of the world's richest man. Fascinated by Buffett's investment magic, she studied Berkshire Hathaway's annual reports, Buffett's letters to partners, and frequently attended his lectures at Stanford University. Had the marriage remained happy, she might have maintained the family's code of silence. However, after their divorce, she decided to reveal Buffett's investment secrets. She collaborated with investment analyst David Clark, a longtime friend of the Buffett family, to write this book. Considered the young investor who best understands Buffett's investment philosophy. Buffett's unique business perspective investment principles, developed over many years, encompass everything from basic concepts to mathematical equations, all designed to help investors make wise investment decisions. Let's explore 3 aspects: Buffett's investment principles, criteria for selecting companies, and timing for buying and selling. Let's start with one of Buffett's fundamental principles, the business perspective investment rule. What does this mean? Simply put, when investing, don't just focus on the stock market itself. Instead, think about the economic implications of owning a piece of the company through its common stock. For example, if your stockbroker calls and says, "Quick, buy this stock, it's up 3 points last week," should you buy? No. This broker approaches investing like betting on horses, hoping to get lucky with a dark horse pick. Remember, common stock represents ownership rights, and as an investor, you should think like a business owner. Making investment decisions purely based on stock price movements isn't rational. Buffett never asks which stocks to buy. Instead, he asks which businesses to buy into and for how long. Once you've decided what to buy, the next question is when to buy it. Buffett says that what you buy and the price you pay are 2 completely separate matters. In the stock market, the purchase price determines your rate of return. Once you have a quote, you can calculate the expected return and compare it with returns from other companies. This seemingly simple comparison method is why Buffett can make decisions quickly. Once he identifies a good company, he simply waits for it to be available at the right price, calculates the expected return, and determines if it meets his criteria. Let's use an example. If someone is selling a retail pharmacy on Main Street, Buffett would review the books to determine potential profits. After confirming sustainable profitability, he'd consider the asking price. If the pharmacy is selling for $100,000 and generates $20,000 in annual earnings, that's a 20% annual return on investment. The final step would be to compare this return with other similar businesses for sale to determine if 20% is a good rate. For Buffett, holding quality companies long-term is more valuable than the short-term arbitrage favored by Wall Street. He often buys into companies when their prospects appear dim to others. He believed that when excellent companies face a downturn, it actually presents the best investment opportunity. Wells Fargo, one of America's best-operated and most powerful banks, set aside approximately $1.3 billion in loan loss provisions in 1990 during a real estate market downturn. To explain, loan loss provisions are a company's estimate of potential uncollectible debts, which appears on their balance sheet. When a bank sets aside these provisions, they're preparing for possible future losses, though these losses haven't necessarily occurred and may never materialize. The losses did eventually come, but they weren't as severe as feared. While Wells Fargo lost most of its profits in 1991, its foundation remained solid with a net profit of $21 million, or 4 cents per share. However, Wall Street, focused on short-term returns, overreacted and treated Wells Fargo like a small regional bank on the brink of collapse. In just 4 months, Wells Fargo's stock price plummeted from $86 to $41.30, a 52% drop, simply because it didn't show significant profits during the 1991 market downer. Buffett seized this opportunity and purchased 5 million shares at $57.80 each, acquiring 10% of the company. His approach was unconventional but calculated. Through his analysis, Buffett recognized Wells Fargo as one of America's best-managed and most profitable money center banks, wielding monopolistic power in financial transactions similar to a toll bridge. In reality, whether small private companies or large corporations, everyone needs bank accounts, business loans, car loans, or mortgages, and banks provide these services while collecting interest and fees. Wells Fargo's location in populous California, with its numerous businesses and financial institutions, provided a vast customer base. By 1997, as Buffett had anticipated, Wells Fargo's stock price had risen to $270 per share. His 1990 investment ultimately yielded a 24.6% pre-tax annual return. During this period, many smaller banks indeed disappeared. This exemplifies how well-managed companies with monopolistic consumer characteristics can survive economic downturns and market slumps, emerging even stronger afterward. Weaker companies often fail, creating more room for stronger ones to expand. In fact, market downturns often present the best buying opportunities for excellent companies. This represents the principle of business prospect investment, which forms the foundation of Buffett's investment philosophy. Let me summarize. When it comes to business prospect investment, you only need to focus on 2 things: what to buy and at what price. Don't just stare at stock prices, look at the company's business prospects. Once you've selected a company, calculate the rate of return and wait to buy at the right price. Speaking of returns, we must mention one of Warren Buffett's most powerful tools: compound interest. Compound interest means that after each interest period, the earned interest is added to the principal to calculate the next period's interest. Simply put, the previous period's interest becomes your principal in the next period. Let's use an example to make this clearer. If you have $100,000 as principal growing at 10% compound interest annually, it will reach about $260,000 in 10 years. At 20% annual compound interest, it would grow to about $620,000 in 10 years, approximately $3.8 million in 20 years, and an astounding $23 million in 30 years. Even a few percentage points difference can create enormous variations in returns over time. Compound interest is the key that unlocked Buffett's success. He strives to achieve the highest possible compound returns over the longest possible time. This point cannot be emphasized enough. Now that we've covered Buffett's 2 investment principles, business prospect investment and compound interest, let's discuss practical implementation. Which businesses can provide substantial returns year after year? Buffett divides investment targets into 2 categories: ordinary commodity businesses, which typically underperform, and excellent businesses with consumer monopoly characteristics. For the first category, if price is the most important factor in consumer purchasing decisions, it's a commodity business. Examples include textile manufacturers, food raw material producers, steel companies, oil and gas companies, lumber companies, and paper manufacturers. These industries face intense competition, so consumers focus primarily on price. When filling up your car, for instance, you're likely more concerned about lower prices. In commodity businesses, low-cost producers ultimately win because they have greater profit margins. To achieve lower costs, businesses must continuously improve their production processes. Commodity businesses have distinct characteristics that Buffett summarizes as low profit margins, low return on equity, lack of customer brand loyalty, numerous competitors, industry overcapacity, volatile profits, and earnings heavily dependent on management's ability to effectively utilize tangible assets like plants and equipment. In short, these businesses aren't worth investing in. the returns it can bring to investors are at best average. So how do we identify excellent companies? What Buffett desperately seeks are monopolistic enterprises. The second type we just mentioned, companies with consumer monopoly characteristics. These companies have powerful brands and recognition, offering products that everyone desires, and they're either the sole provider or far superior to their competitors. It's like a toll bridge. If consumers want to cross the river without swimming or taking a boat, they must use the bridge and pay the toll fee. This is where the monopolistic nature comes into play. To discover such companies, take a stroll through convenience stores, supermarkets, bars, and pharmacies. You'll have an aha moment. Think about which brand of milk your child drinks every morning, or which cigarette brands are sold in every convenience store. There are countless examples of globally available products, like Apple phones and Coca-Cola. Of course, besides monopolistic advantages, investment-worthy companies should possess other characteristics. An upward trend, no debt burden, high return on equity, ability to retain earnings, and capability to invest in high-return new projects. Now, where can we find these excellent companies? Buffett suggests that standing at the entrance of a supermarket or convenience store and identifying must-stock brands is far more effective than flipping through financial magazines and newspapers, or simply list the brands you use daily. These companies are often like toll bridges, with brand appeal and products that retailers must carry. Advertising companies are another example. Advertising has become a fierce battleground, with large companies investing billions. It's a point of no return. They must continue their advertising campaigns, ensuring substantial revenue for advertising firms. There's also an unexpected category, companies that don't require products or highly skilled workers. These are essential service providers like security companies and courier services. They offer continuously needed services without requiring significant capital investment or highly educated employees. As long as theft exists and e-commerce thrives, these businesses will prosper. These companies will be profitable. In summary, we discussed three types of companies: those with guaranteed product sales, advertising companies, and companies providing essential services that everyone needs. Where should you invest? Focus on these three categories. We've discussed various buying strategies, but when should you sell? While the investment market is filled with various bull and bear market theories, Buffett's rule is to ignore them. He can do this because his decisions to buy or sell stocks are based on the rate of return, regardless of market conditions. He barely considers these factors, focusing mainly on the businesses he consistently monitors. Buffett knows that unpredictable bull markets can present excellent opportunities, but he's also aware that bear markets, when company stocks are undervalued, can offer great business prospects. During the 1987 stock market crash, when the market was in chaos and people were frantically selling their stocks to avoid risk, Buffett stood quietly at the bottom, waiting for his favorite quality companies. When Coca-Cola's valuation took a hit, Buffett saw it as a once-in-a-lifetime opportunity and invested an additional $1 billion instead of selling. He didn't sell stocks to secure cash during these times, nor did he stand idly by. Instead, he saw others' fear as an opportunity. This confidence stems from his investment decisions based on business prospects, contrary to Wall Street's mainstream investment philosophy. Business prospect investing focuses more on patterns and wisdom. Others' foolishness becomes your harvest field. In other words, only when business prospect investing has commercial value can you profit from others' fear and greed-driven mistakes. By following patterns when others make mistakes, you can achieve investment success. To summarize today's content, this book teaches Buffett's unique business prospect investment method. Don't just focus on stock prices. Look at the business's operational prospects. Once you select a company, calculate the return rate and wait to buy at the right price. Compound interest will double your investment. When you buy a stock, hold it long-term as long as the company's economic condition doesn't significantly change. Where should you find such excellent companies? Choose businesses with monopolistic advantages, focusing on three types: companies with guaranteed product sales, advertising companies, and companies providing essential services. When should you buy? Buffett insists on buying quality companies when stock prices represent commercial value. He buys stocks when a company appears to be in a downturn because he believes that's the best investment opportunity for excellent companies. When faced with so-called bear or bull markets, Buffett chooses to stick to his principles, ignore various selling theories, and view commonly acknowledged fears as opportunities, while persistently making investment decisions based on a company's future prospects. Throughout his life, Buffett has never stopped learning and continuously refined his investment approach. As ordinary investors, we should also constantly learn from the successful experiences of our predecessors and master the essentials of investing. Only by understanding the ins and outs of these investment methods can we truly absorb them, making it easier to improve our skills in real-world practice and make predictions and judgments about the future. To succeed in the investment field, beyond learning methods and analytical tools, you need business acumen. It's not just about the conclusions drawn from analysis, but also about the intuition that comes with business talent. While not everyone can become Warren Buffett, we can at least continuously work towards that goal and become successful investors in our own right.